by for an urgent message from the crack team at Stacking Benjamins.
Live from Joe's mom's basement, a special episode of the Stacking Benjamin Show. We're covering the second biggest bank collapse in the USA since the Great Depression. Here with details are Joe and OG.
Hey, thanks, Doug, and welcome to a special episode of the Stacking Benjamin Show. You've probably already seen online, Silicon Valley Bank was taken over by FDIC. We'll share what happened, what we think it means, how this affects your planning, and if you know anybody who needs to hear this episode to get off the ledge, please share this with them. But, OG, let's just start with the details about what happened. Silicon Valley Bank really tied into the tech community in a big way. And before this collapse was growing very, very quickly. I think they doubled in assets, almost nearly doubled in assets in the last year.
Right. So as you know, from a banking standpoint, what banks generally do is bring in capital, lend out money, and pay interest, right? That's kind of the role that the banking system plays, or an individual bank plays within the system. And just like a mutual fund, you know, you see those top mutual fund lists or ETF lists of this fund was the hot commodity last year. This was the best performing thing last year, that all the money goes into it. And then what happens? The fund manager can't handle all the cash. Like the ideas and the trades that made them successful aren't able to be duplicated because there's too much money involved now, right? You can't go buy 10% of Apple and expect not to have an impact. So kind of the same thing was going on in the banking world here with this bank. So much money came in, so much VC money, so much capital of other companies, and they couldn't deploy it fast enough. And when they did, they tried to do the safe and secure thing, buy treasuries, but maybe bought them at the wrong time.
Yeah, the Federal Reserve raising interest rates right now really played into this, I think, on two occasions. Number one, OG, we had a lot of tech startups. You know, our podcast over the last 12 years, we always have this steady stream of fintech startups that want to come on the show and tell us what they're doing. We haven't had hardly anybody on lately.
12 years in, we're still a startup.
We truly someday, Grasshopper. But that has slowed because of the fact that obviously we're seeing what's going on in the technology sector, not as much call for it, and partly because we saw interest rates going up. And as interest rates went up, it was a tougher environment to get money for these new startups to get money. So number one, Silicon Valley Bank not bringing in as much money, not as many new startups coming around. But then number two, to your point, when they deployed the money, had to buy into the market because when interest rates go up, the value of treasuries drop.
Yeah, it's not even just the treasury side of that. The other part of that low pressure system is the ecosystem that startups really function within is the venture capital world. And those VCs weren't able to get money either because of the cost of funds changing with the interest rates. And so as that money dried up, which they heavily relied on to fund their operations and fund payroll, et cetera, they had to go tap into their accounts at their friendly Silicon Valley branch on the corner. And then that fed into all of the things OG just talked about, which is their value of the bonds that they bought to fund their operations were dropping.
Yeah, so think about it in terms of kind of like the dominoes that happen, right? So Doug starts El Camino Inc., right? He goes out and raises a whole bunch of money and gets $100 million. Well, Doug's got to take that $100 million. He's got to do something with it, right? So he says, well, I'm just going to dump, I got to put it in the bank because we're going to develop new whatever technology or whatever. In the meanwhile, I'm paying payroll, that sort of thing. So you've got a bank account that's got $100 million in it. Well, the bank's not going to literally have $100 million in cash sitting in that actual branch, right? So they're part of the banking system. One of their jobs is to take that money and go invest it, which they did. But now multiply that by a whole bunch of people all doing it at the same time early on, COVID, that sort of thing, right? All this money coming in. And then, like you said, Doug, now all of a sudden that flow dries up. I don't want to use the word pyramid scheme, but that's kind of,
No, but
that's
it all
what
just
happened,
comes
right?
crashing down.
Yeah,
You've got all these
it
things
just kind of
crashing
like
down.
all the money was coming in, and so you always had this flow of cash coming in. So then, what Doug goes, hey, I need $1 million for payroll this month. The bank was like, cool. Well, OG and Associates just deposited $100 million, so we've got the cash. We're moving the deck chairs around. It's the same deal. But as that flow dries up, like you said,
then they
caused an issue.
Go ahead, Joe.
We just talked about
an issue.
We just talked about 3 different ways where rising interest rates cause this to happen, right? I mean, three big ones.
Well, exacerbated this.
Exacerbated this.
Didn't cause it from happening.
Contributor.
Right.
Yeah.
Yeah.
But this is also true when we talk about like interest rates. This is also why for the better part of, Bill Gross said that he happened to get super lucky. Bill Gross was the fund manager at PIMCO, right? One of the top fixed income fund managers of all time. And if you asked him what made him so successful, he would say declining interest rates. Like interest rate, he started in the 80s, and literally as interest rates continued to go down his whole career, he was like, this couldn't be
Thanks,
better.
Mom and Dad, for birthing me when you did.
Yes, exactly. And so the way fixed income works, bonds versus interest rates, is you got to think about them like a teeter-totter. And I guess, do they still have teeter-totters?
They're virtual. They're on phones now.
Does anybody use a playground anymore?
Yeah.
A virtual teeter-totter? Yeah. Like, hey, I just texted you. I'm on the teat part of the totter. So are you going to, but you try to... Okay, sorry. Anyways, so teeter-totters and interest rates, fixed income. So when bond prices are lower, when interest rates, so what's happened over the last 40 years, interest rates have gone down, right? Continually gone down. So bond prices have gone up. And we know, just as recently as a year and a half ago, interest rates are, as low as they've ever been. So when companies are trying to find safe, air quotes, or investors are trying to find safe, air quotes, places to invest their money, they look at those CD rates. Think a year ago, 3-month CDs, year-long CDs, 3-year CDs paying 0.71. And so what do? They say, well, I'm going to buy a 30-year bond. Well, the problem is that the multiplier effect of duration, so how long that bond is versus the interest rate change that happens, is an X. So it's like if I have a 30-year bond or a 20-year bond and interest rates rise 1%, it's 1 times 20. So I get a 20% decline in my price.
I think there's even another way to think about that, OG. Just if I'm holding on to a bond that's paying 3 and new bonds come out paying 4, nobody wants my bond. So what do I have to do to get money? I gotta sell it at a discount so that it's competitive, so that anybody's going to buy it. I think that's an easy way to think about it.
Except that if time were okay, if you had unlimited time, all bond prices go back to the price that they were when they were issued, right?
Same.
The problem is that when you need to redeem that bond.
No, I'm not disagreeing with you. I'm agreeing, and I'm marrying that thought up with what Joe just said, because they can't wait for that 30 years. They got to sell now to fund the run on the bank.
Problem. So I've got this 10-year bond, I've got this 30-year bond, and it's like, oh crap, the money dried up, which is what you're talking about. And now, so I got to go sell something at a discount. And now people go, hey, I just heard that SVB is selling bonds at a discount. Maybe we should, and now it just... And
then you got that great scene from It's a Wonderful Life.
Well, yeah, let's go to the next domino, which is that so Silicon Valley Bank sees the writing on the wall. They realize that this isn't going to work. We've got these long-term positions and now interest rates rising very quickly. We're going to have to change gears. So they put out the call for new investors. And when they put out the call for new investors, big venture capitalists and advisors in Silicon Valley begin to think maybe there's something bad going on here, and they begin advising their clients, their startup clients, their incubator clients. I think you really got to watch out, and you may want to start pulling your money. And we're off and running then, OG, I think, on an old-fashioned hootenanny. We are just over a 2-day period taking money out quick from this bank. which is trying to do the right thing, by the way. They're trying to
a lot of those executives from those companies were really stuck because, as I understand it, the covenants of their corporate debt said you've got to also have all of your personal funds here as well. So their mortgages, their wealth management, all of that stuff was also there. And if they tried to pull all of that money out, they'd be breaking the covenants of their corporate debt. And so now they're really in trouble. So they're like caught between a rock and a hard place. And if they don't to save their personal stuff, then, and they can't fund payroll, now all of a sudden they've pierced the corporate veil and all of the liability protections they get as being an officer of the company if they can't make payroll, and now they're personally liable. So they are really in bad spaces.
Flows back to them. OG's check bounces, and he doesn't just sue the company.
I don't check. I don't bounce checks anymore.
He doesn't just sue the
Circa
company.
2003, maybe.
Because you just know not to try to deposit them.
Yeah.
Because he gets a stack of Benjamin's check, he just frames it. He's like, yeah. But he doesn't just sue the company. Now the directors, the CEO, they are personally liable. Now, people are thinking, well, wait a minute, there's FDIC insurance. FDIC insurance covers $250,000, which, OG, is a lot of money for you and me to have in a bank account. I don't think we tell many people to keep $250,000 in a bank account down at Silicon Valley. But if you're a corporate client, if it's a company, that's $250,000 is not a ton of money for a company with 200 employees. And also, to Doug's point, when these companies sign up to get money, to get loans, to get cash from Silicon Valley, they also have to have their personal mortgage there. They have to have their personal assets there. And now I've got my own stuff. I've got my company stuff, and the covenants of how I work, to Doug's point earlier, are all tied in. I got to make a choice. I either got to break the contract that I'm in to save my company, or I got to hope like hell the company can reverse course. That's tough.
So what do you do with that? You know, like I can't imagine having to make that decision over the last couple of days as an executive at any of these companies. Yeah. I've also heard of people who are like third party related, right? Like, hey, we're good.
Sure.
We're good. But we run our payroll through.
Yeah.
And we had just deposited our payroll at such and such a company, and now they're frozen. And so it's like, it's all these secondary and tertiary effects.
I got an email today from Gusto, sure. And some of our affiliate programs run through Gusto, and Gusto wrote and said, hey, just to let everybody know, because we have 50 million emails, we are not affiliated with Silicon Valley Bank. Your payroll system through Gusto is going to be just fine.
But I bet they're also sweating bullets at Gusto, going like, oh crap, how do we,
sure,
how are we not the next one, perhaps?
Well, first of all, I would make sure you don't have an acronym for your name that has an S and a B in it. Anyway, I think the ripple effects here, there's certainly going to be ripple effects from tech supply chain standpoint and in that tech industry internally. And some of it'll leak out. I'm sure it's going to make the news, and it'll be kind of hyperbolic. It's going to get a lot of people to worry. But my question for you guys, and on behalf of our listeners, is: do you think the average, I'm not going to say average Joe, I can't give you that. The average Mike should worry about this. The average Mike and Mary, should they be seriously concerned that this is going to impact Bank of America and Citibank and whoever their local banks might be?
Maybe it'll take down Wells Fargo.
If we're lucky.
I'm kidding.
I mean, my understanding is that, but that Silicon Valley Bank was built their entire business model around the tech industry. 99% of all the business they did, their investments and their customers were all in the tech industry. And with the tech industry having a major correction over the last year, it is going to impact them more than another bank that is far more diversified in its client base and its investments. Does that ring true to you guys? So
the interesting thing is that apparently some of the executives, or at least one of the executives at this bank, was an executive at Lehman Brothers. So not that we couldn't have seen that writing on the wall. I'm just kidding. Obviously, they tried to do their best, but
Sure. We've got that via Reuters, by the way, and Fox Business. So we've got that from two different places.
Obviously, people aren't trying to like muck stuff up. I'm just kind of making fun of it a little bit. But
he left Lehman a year before the collapse. And if you remember, that also moved very fast.
So Doug's question on this was like, does the average, person have to think about this? I do think that you have to recognize that a bank failure is very, very unlikely. It happens. In fact, the last 5 or 6 years, if we look at the number of bank failures, it's been really, really, really low compared to historical averages. Usually 100 banks a year fail. And when we think of that, we go, a failure? Like, how does a bank fail? Well, it's just, the FDIC, like we talked about at the beginning, the Federal Deposit Insurance Company corporation shows up and says, hey, we've got to take this over. You guys haven't done a good job. We're gonna make everybody whole.
And they find somebody to buy it, right? They find another bank to buy the assets.
Merge or do whatever they're going to do. So
they have already,
the numbers.
They have already, OG, just to clarify that point. FDIC's already set up another corporation. They've already moved the assets over there. They're going to begin selling the assets for anybody with under $250,000 of assets. The amount that was protected by FDIC on Monday, according to every outlet we've seen, you're going to be able to get your money out. Over $250,000, you get what they're calling an advanced dividend, which means that you get in line. You're going to be able to get some money, but it's based on them selling off the assets of Silicon Valley Bank, and it'll depend on what they get. So you'll get maybe some.
They're just going to be standing there in their all birds next to their Tesla plaids, waiting in line for
maybe
their
not
dividends.
The day, Doug. Maybe not the day.
Not today, bro.
Oh, sorry.
So if you're somebody that has a decent amount of cash, FDIC insurance covers you for $250K. That's per account ownership. So you think about the three of us that are here, we could each have an account at the same bank. We could all have joint accounts with each other at the same bank and all be covered for each one of those accounts. But as soon as we double dip ownership, OG's got an account, then OG has a separate account that has $250 in each. Only one of those is covered. OG has an account of $250. OG and Doug have an account for $250. Both of those are covered for $250. So ownership really matters. If you're going to have extra cash, you have to just be aware of this. It's exceedingly rare. You say, well, my money's at JP Morgan. It's at Chase. It's at Bank of America. It's at, if you have 260,000, are you likely to be made whole? Yeah, probably. I would say, yeah, probably. But why bother with the gamble? Like if you're going to have 300,000 or 400,000 in a bank account, why not make sure that you have it titled correctly? Why not just spread it out? Go to a different bank. And I can already see from a sales standpoint how this works. So let's say that you're one of those people, right? You've got 500,000, you got a banking relationship, you've got a banker, and you go, I'm pretty nervous about this. So I'm going to go take, I'm going to take some of my money and diversify. I'm going to go take to a different bank. Your banker goes, no, we're never going to go bankrupt. We're JP Morgan. We would never go, I'm guessing that's the same thing that happened at this bank. I'm sure someone eventually at some point in time was like, well, what happens if I got all this venture capital money that I just raised for $100 million? Like, how do I know it's going to be here tomorrow? Oh, we're a huge bank. We've got $40 billion in assets. We're never going to go bankrupt. Like, oh, okay. So.
And in this case, by the way, they did not go bankrupt. They were taken over by FDIC.
Well, because they were on the way to go bankrupt. And that, right. Yeah. And I think it's also important to recognize the difference between like the assets of the investor, i.e. the shareholder, right? The people who own the company versus the assets of the depositor. There's two different things there, and banks obviously use the asset of the depositor for investment, long-term investments. But like we talked about at the beginning, if all of a sudden those dominoes start to fall and people start showing up going, I'll take my 42 billion, which is the article that I read that said on Friday, people showed up trying to withdraw $42 billion. They go, yeah, we don't have it. I'll take Hundies. I'll take Benji's.
That's a lot of Patagonia backpacks.
I'll wait.
Still too soon.
Patagonia would be more a Wall Street, wouldn't you say? Not a Wall Street, bro.
Yeah,
Patagonia
the vest. Yeah, the finance vest.
Okay.
Yeah, maybe.
Too soon.
I think on my end, there's a couple different things here. Number one is if you're in the tech industry, I think I am worried. I think we're not going to know the ripple effects right away. We're definitely going to see some layoffs on Monday. I think we're all waiting to see exactly.
Also, the market's going to suck on Monday.
Yeah, but with the market, you and I can easily say don't do anything, right?
Yeah,
that's going to be except buy. If you happen to, we don't like timing the market, but if you happen to have money that for some reason was just sitting there, that probably is going to be an opportunity. But but if you're in the tech sector, I think I watch Monday and Tuesday to see where the layoffs happen, and I see what companies that are affiliated with me really have stuff going on. We've said no matter what industry you work on, you should always be working on your resume anyway. You should be working on your network. Keep your LinkedIn profile, always be building that. Is probably some people are going to get that reminder in tech. If you're outside tech, I kind of agree with what I read earlier today in the LA Times, which was, this is tech's problem, not yours. Talking to most other Americans, OG, which is JP Morgan. We're not going to see anything change there. And if you're just the average person with a bank account, I don't think there's going to be a widespread collapse of banking. There could be widespread panic. We could see people go to their bank because nobody understands how any of this stuff works. Maybe, but I don't know. But I think I think one more last thing, OG, before you go. There's also a case study here, which is the number of outlets that talked about all your eggs in one basket. How many times over the last 12 years have we said that? You really, no matter how great it seems, how cool the bet is, how can't lose it seems to be when you put everything into one place, like Silicon Valley Bank was Tech's bank. We see what happens.
Yeah. And I kind of want to address that a little bit around investing, because sometimes people will say, well, doesn't that mean then that I should have a Fidelity account and a Vanguard account? And I would say the answer is no. These are completely different things. You don't need to have both, because your ownership of your ETF or the ownership of your, the stocks that you own, convey the ownership rights to you regardless of where those are recorded on, on a computer file, whether it's at Schwab or Fidelity or Vanguard or wherever, right? Where diversification of companies matter is kind of what we're talking about here, where you run up against a very firm limit. I mean, the FDIC says we'll insure you for $250K per account ownership per bank, and we just kind of take that at face value and go, okay, that's fine. That's cool. Well, so if it's at 500, so who cares? They'll be fine. Well, no, there's a rule about that, that doesn't apply necessarily to your Fidelity account. I wouldn't be racing out and going, well, I need to open a Vanguard one because I only do business at Fidelity right now. Two different things.
I think the big lesson for everyone here is obviously there's going to be a lot of stuff that's going to happen in the next few days. I think, OG, it's a mistake unless you're in the tech sector and to be glued to CNBC, Fox Business, the Wall Street Journal 24/7 the next few days. I think that's a huge mistake unless it's going to directly.
I recommend everybody meets me in Beaver Creek to go skiing.
Just take your brain right off.
That's one of the most OG statements ever.
Take your brain completely off of this. If you have
short-term fluctuations, all that sort of stuff, it is what it is, right? Guess what? If you're trying to trade your stock on Monday morning because you're worried about the market going down, there are 10 bajillion shares already traded before you even woke up. Yep. Like you're not going to get the good price. Just it is what it is. At this point for those things. If you're bold and you feel like doing a little buy-in, Probably some opportunity there.
And let's be clear, we are not calling our shot saying that things are going to be phenomenal Monday, and on Wednesday you're independently wealthy off a $100 bet, right?
That'd be sweet.
We're not calling that things can't go worse, or that there won't be,
but it might happen,
or that there won't be a widespread panic. I mean, you don't know what comes next. This is news, and there's going to be more news on Monday. Definitely, there's going to be more news on Tuesday.
Yeah.
But I think that if you've got less than $250,000 in a bank account, FDIC takes care of you. They're taking care of it here. Keep your long-term plan.
Yeah. If your plan hasn't changed, your portfolio shouldn't change. Full stop.
Thanks for hanging out. Doug, OG, thanks for coming in for overtime. You guys will all get triple pay.
Time and a half,
triple
baby.
Pay.
Time and a half.
We're going triple pay for this one.
Triple?
Woo.
Absolutely. Yes.
He must have pulled.
Don't write checks your ass can't cash. Saul-Sehy.
All right, that's it. We'll see you next time. Doug, I think you've got some quick credits for us.
Thanks for listening and sharing this special episode of the Stacking Benjamin Show. Join us Monday for our regularly scheduled show where we're comparing the best tax software on the market.